Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day. Post a choppy IPO debut and subsequent hiccups in the secondary market, there is finally some good news for digital payment behemoth Paytm. It has received the RBI nod to operate as a scheduled payments bank. How does it change things for the company? This report makes sense of Paytm Payments Bank's new status.
Billionaire Vijay Shekhar Sharma's Paytm Payments Bank has been upgraded to a scheduled bank by the Reserve Bank of India. Scheduled banks refer to those which have been included in the second schedule of the Reserve Bank of India Act 1934. This is expected to help the 4.5-year-old bank expand its financial services operations, as this makes it eligible to partner in government-run financial inclusion schemes. Other payments banks that have been added to the second schedule include Fino Payments Bank and the India Post Payments Bank. As a scheduled bank, Paytm Payments Bank can take part in request for proposals issued by the government and large corporations, primary auctions, fixed rate and variable rate repos, and reverse repos, along with participation in marginal standing facility. It now becomes eligible for refinancing facility from the RBI at the bank rate and acquires membership to the clearinghouse, as well as getting access to currency storage facility. Banks which satisfy the RBI that their affairs are not being conducted in a manner detrimental to the interests of their depositors are included in the second schedule. Paytm Payments Bank, which is owned 49% by 197 Communications and 51% by its founder Vijay Shekhar Sharma, had 64 million savings accounts as of March 31 and over Rs 5,200 crore in deposits. Even with the status upgrade, being a payments bank, it still cannot lend or issue credit cards on its own. Payments banks would be eligible to become a small finance bank once they complete 5 years of operations. They can then undertake lending activities. This conversion is not automatic and requires the central bank's approval.
When the RBI registers you as a scheduled bank, then there are two things that can happen. One is in the normal course, let's say either a cooperative bank which got scheduled, let's say, or if you are let's say a small bank and then you become a small finance bank and you become a scheduled bank, then you get a certain set of benefits. You can participate in settlement directly. You don't have to approach another bank for your settlement. So there are those kind of activities that you can carry out if you become a scheduled, if you're a scheduled organization, scheduled bank. In case of payments bank, however, the one or two areas where I suppose, you get a benefit of becoming a scheduled bank, let's say, is that, let's say, you can make investments. There are few guidelines associated with investments in terms of directly participating in the repo, reverse repo kind of market, and also some settlement kind of additional benefits you get, which in the normal course of payments bank would have got. So if you study, let's say, typical payments bank and this particular payments bank as well, then you'll realize that since they do not carry out lending, since they do not carry out, any particular kind of, let's say, activity, even the deposits, for example, there is a limit that the license itself sets out. I mean, when you become a payments bank, you cannot accept deposits beyond a certain amount. So all those conditions will remain, except that you can get some additional benefits. The other side of the whole thing is that when you become a scheduled bank, you're supposed to, the compliance, increases. You are supposed to, every 14 days, there are a certain set of reports. There are periodic reports that you're supposed to comply with and provide to the regulator's office. So that's an additional responsibility that is cast by the regulations, under the minute you become a scheduled bank.
According to RBI guidelines, the maximum balance an individual payments bank customer can hold is Rs 2 lakh. Therefore, a scheduled bank status will not fundamentally alter the way in which Paytm Payments Bank is conducting its business.
Well, Paytm Payments Bank now has new opportunities to explore with its scheduled status. But FMCG distributors in the country are apparently losing ground to the organized B2B players. The apex body of distributors of FMCGs has issued a veiled threat recently, saying they will disrupt supplies to Kirana stores if FMCG companies don't stop supplying products at lower prices to Reliance's JioMart and other such players. JioMart's B2B business model has created a dilemma for India's FMCG companies who risk alienating the 4.5 lakh distributor community at the cost of the modern wholesalers. Let's find out the stumbling blocks in JioMart's path to dominance. Neighborhood stores that sell us everything from salt to soaps are increasingly partnering with Reliance Industries' JioMart to procure daily essentials. While orders placed through the JioMart partner app are delivered quicker than the traditional distributors, shop owners are mainly attracted to its discounts, which sometimes go as deep as 20 to 25%. With his deep pockets, Mukesh Ambani is bringing his tested blueprint of offering heavy discounts to change the retail distribution landscape in India. Reliance wants to serve India's 13 million Kirana stores that account for 80% of the country's $900 billion retail market. Reliance's aggressive entry into telecom led to a consolidation in the sector. But the company's strategy to replicate this in B2B retail has already started to face opposition from traditional distributors who have been servicing every nook and corner of the country for several decades now. Reliance has created antagonists out of lakhs of salesmen in the traditional trade who are struggling to match prices offered by JioMart. The opposition is being led by the All India Consumer Products Distributors Federation, or the AIC-PDF. It represents 4.5 lakh distributors who serve about 5 million Kirana stores on behalf of FMCG giants like HUL, Reckitt, Nestle, and Colgate-Palmolive. The organization has approached FMCG companies demanding a level playing field, saying traditional distributors must get products at the same prices as modern ones like JioMart, Udaan, and Metro Cash and Carry. To understand their main concerns, we spoke with Federation's president, Dhairashil Patil.
The rates going to the retailer decided by the company because the billing is done on the company software. The schemes going to the retailer are decided by the company. So we don't have any say in that. The discounts which has to be offered an individual distributor are governed by the company itself. Average margin for the distributor is from 3.5% to 5%. So now the issue is that same set of product with same set of MRP are being delivered by another channel that is called eB2B channel, wherein companies like Udaan, JioMart are selling same set of product with a price lower than the distributor is delivering. So it is creating a confusion in the market that the distributors are been earning so much amount of money since last so many years. The distributor, the rates which are offered by these new companies are lower than the landing price of the distributor. And that is lowered by 10 to 15%. So this is creating a rift. So our point of concern is that this is a new era wherein all the shortest route to monopolize the market is giving discounts. Here, what is happening now, the trade has been disturbed. We demand a price parity in the market. And if the distribution system which is there since last 60 years is going to go out of business, then who will supply? Then this entire retail chain will be left at the mercy of this so-called eB2B or modern. See, this depends upon the companies. Ultimately, we are working for the FMCG companies, and if the FMCG companies want to give away their freedom of selling their goods at their will, then it is up to the companies, because ultimately, if the viability of the distributor does not work out, the distributor cannot do a business.
It is not clear if FMCG companies are offering goods to likes of JioMart at differential rates, but Dherashil Patil believes that the discounts are a function of intense cash burn by modern B2B companies. Last year, Reliance Retail raised $6.4 billion from outside investors. FMCG firms are being questioned as to why the same flexibility is not being given to their existing authorized channel partners. If its demand for price parity is not met, AICPDF said its members will stop supplying products that are being carried by JioMart and others. Not just this, they have vowed to not support FMCG companies with their new launches after January 1st. The traditional distributor base is essential for new launches as they take the risk of testing the waters for the product. On their part, FMCG companies are engaging in dialogues with their distributors as upsetting them may not be the best way forward. Even as Reliance pushes its own private label brands to neighborhood shops using JioMart, it largely remains an intermediary for consumer goods companies in the B2B space. Therefore, unlike in the case of Jio, where Reliance was free to set its own rates, here the pricing power is decided by the likes of HUL and Nestle. Whether or not Reliance can disrupt the B2B grocery space rests on the shoulder of FMCG giants in the face of opposition from the vast traditional distributor community, whose livelihoods are now being threatened by JioMart. While B2B retail is poised for disruption, the Indian markets continue to be volatile. Even as global equities trade mildly below their record peak levels, Indian equities have tumbled 10% from their lifetime highs. This is the first noticeable correction in about 20 months, which was triggered amid expensive valuations and the re-emergence of a new coronavirus variant. While the near-term trajectory for Indian markets will be based on US Fed policy and economic data due this week, the long-term direction will be guided by liquidity, commodity inflation, and status of the pandemic. And as the world prepares to welcome 2022, Business Standard's Puneet Wadhwa welcomed Marc Faber, editor and publisher of the Gloom, Boom and Doom report on how investors should approach the financial markets next year, his investing strategies, and the road ahead for Indian equities.
Hello, Mark, and welcome to the show.
Well, thank you very much for having me, and welcome to all the viewers in India.
It has been a boom in the global equity markets for most part of 2021. Will they carry this enthusiasm in 2022 as well?
I think the enthusiasm of investors will not vanish overnight. It's a process that takes time, and maybe in India it will stay at the high level for a while, because the Indian economy is one of the few economies in the world that, despite of everything, is still expanding. We have to see that very clearly. So I think that maybe in India, you have a situation where the economy outperforms the rest of the world, and the stock market continues to do well, maybe not as well as in 2021. But I think globally we need a correction in markets here. There is, as you pointed out, too much optimism among investors, and mostly among investors who have no experience. They are, the people that bought into cryptocurrencies, into meme stocks, concept stocks that have no earnings and so forth.
Equity markets, inflation, commodities, now cryptos, everything seems to be on an upswing. Is this going to end badly for the financial markets, let's say a year from now or 2 years from now?
Well, I think if we look at 2021, one sector that hasn't done well are gold shares, precious metal stocks, and value stocks. Value stocks around the world have been left behind, and what has performed in the US are the FANG and FANG-related stocks, Facebook, Amazon, Netflix, and so forth, Apple, and semiconductor stocks, and stocks like Tesla. But overall, the typical stock hasn't done very well. And I think that we are at the juncture in the markets where these favorite of investors, where hedge funds are heavily weighted, the FANG stocks, I think they will underperform and the money will flow into value stocks. That's my impression.
What has been your investment strategy, Mark, over the past 1 year?
Well, my strategy is always the same: diversification. I don't need to make speculative gains. I have mostly value stocks in my portfolio and high dividend stocks. In other words, in Europe, I have utilities, and I have some banks here in Asia. They have dividend. When I bought them, they had dividend yields of 4 or 5%. And I have some tobacco companies. And of course, I have some resource companies, because I believe that commodity prices are not gonna collapse. I have gold shares, and then I have real estate around the world, and I have precious metals, and I have fixed interest securities.
What about India? Do you hold India on your portfolio?
I hold some bonds on Indian companies, and occasionally I own shares in the Indian ETF.
Okay.
But at the moment, I have no position. I think the market is fundamentally sound, but fundamentally very expensive. It's the most expensive market in Asia, and I find much better value elsewhere in Asia.
Which other markets where you find value, Mark?
I think there is some value emerging in Indonesia. It has similar characteristics to India, not as well developed as India, but as a country, it's similar. Then I have in Malaysia some holdings, and of course, Singapore, Hong Kong. Hong Kong is very cheap.
So what's your advice to investors? How should they approach equity markets in 2022, especially in the case of India?
But you understand, you say advice to investors, it depends on whom. I would say preservation of capital becomes now more important than thinking, how can I make or double my money? You can probably double your money, but you have to take an approach of a casino. I put everything on black, and if at the roulette table red comes out, you lose everything. You understand?
Absolutely.
So as an investor who is interested in investing for the future or for his long term or for his family, there's only one thing: diversification. In real estate, in stocks, cash and fixed income, and precious metals, and maybe some cryptos and maybe some commodities. But the broad asset allocation is this diversification, and not all the money in one country.
Thank you, Mark. Thank you so much for your time. We hope to see you soon.
Well, same. Bye-bye. And Merry Christmas to all your viewers.
If you believe Marc Faber, diversification should be your mantra for investments in 2022. You must have heard about long and short positions in the market. Do you know what exactly these terms mean and how different are they from each other? Business Standard demystifies it for you. In the market, if you own shares of a company and expect it to rise, it is considered a long position. But if you are bearish about their future and sell them even before they are transferred in your name, it is called a short position. Typically, when an investor shorts a stock, he borrows the share in a margin account from a brokerage firm and sells them. Having said that, long and short positions are mostly related to the derivatives of futures and options segment, where the trading happens in the present for future delivery of shares. So, your trade in the F&O segment is accordingly termed as long or short. When you as a trader buy a future contract of any index or stock in anticipation of a price rise in the future, you are said to have built a long position. On the other hand, when you as a trader sell a future contract of any index or stock in anticipation of a price drop in the future, you are said to have built a short position. In future and options, you choose calls or sell when you are bullish about a stock or index and expect the price to rise in future. So, in a long position, investors choose the call option, and those opting for a short position select the put option. A put option in the future and options segment is opted when the investor is not bearish about any stock. So, more long positions in the market suggest that the outlook is optimistic and people expect the indices to go up, while a rise in short positions mean that the feeling is bearish. That's all we have for you today. We will be back tomorrow with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.